Hello everyone, welcome back. This week we are going to be covering Chapter 8, which is Fraud, Internal Control, and Cash. And so going back to Chapter 5, you learned about the Perpetual Inventory System, which is a system that allows companies to continuously record sales and keep track of inventory. And you also learned that some companies used a point of sale system or a POS system or scanners to facilitate the continuous recording process. And so these tools that were covered in Chapter 5 can also help with fraud and internal control, which are going to be the topics for this chapter. So in Chapter 1, I presented to you the Sarbanes-Oxley Act and showed you a short YouTube video that briefly explained the history and the reasons for this act. So if you need a refresher, please refer to my lecture video for Chapter 1. But I bring it up again because it is covered in this chapter, and as a result of this act, all publicly traded U.S. corporations are now required to maintain an adequate system of internal control. And this was largely due to the numerous scandals that were very public at the time, and that it was in relation to fraud. So even though small businesses may not be required to follow what is stipulated in the Sarbanes-Oxley Act, businesses should still implement measures to prevent fraud. And so this can be done by implementing processes for internal control. So how can we excuse me. So what is fraud? And why does fraud occur? Fraud is a dishonest act by an employee that results in personal gain at the expense of the employer or a company. And so there are also three main factors that contribute to fraud, which include opportunity, financial pressure, and rationalization. Fraud occurs because the workplace provides an opportunity for employees to commit fraud, and this typically results when the business lacks the necessary protocols to prevent the fraud in the first place. So let's think of a retail store with a cash register. There's only one that is used by multiple employees during the day, and there is no system to determine who used the register at a certain time. This typical situation opens the doors for fraud because there is no way to make one person specific accountable if there's money missing. Okay? So fraud also occurs when there's a financial pressure. Perhaps the employee is in financial distress because of high debt, or they're living a lifestyle that does not support their income. And then there's also fraud that may occur because of rationalization. And this is when an employee justifies fraud because this employee may believe that he or she is underpaid by the employer and or believes that the business is making massive amounts of money. Okay, so how can we prevent or minimize the possibility of fraud? Well, business owners can implement internal control methods or systems, which consists of 5 primary components. We have control environment, which is when the top management or business owners set the tone internally in terms of the expectations and the values of the business, including the expectation of integrity and the no tolerance policy for unethical activities. And then we have risk assessment, where the business identifies and analyzes the risk factors and determines how to manage them. We also have control activities that serve as methods to reduce fraud, and I will be going over this particular area in further detail. And then we have information and communication, which is simply what it states. The business must capture and communicate pertinent information up and down the organization as well as with external parties. And then we have monitoring to check for adequacy. So in this chapter, we're going to focus on control activities since this is the area where businesses can address and control the risks of fraud, okay? So now, businesses can have different control activities. There's no right or wrong answer. It all depends on what the business decides. But the book gives you 6 principles of control activities, which are included in this slide. We have establishment of responsibility, segregation of duties, documentation procedures, physical controls, independent internal verification, and human resource controls. For establishment of responsibility, this is when one person is responsible for a specific task. So let's go back to my previous example of opportunity for fraud. I mentioned a retail store with one register and multiple users without a user tracking system. So businesses can solve this problem by having registers with multiple drawers and by requiring passcodes or logins to keep track of who is using a register at a specific point in time. And another example is I recently went to Kaiser Permanente to take my child to the doctor, and he was prescribed medication, and so I went to their pharmacy, and while I was waiting, I noticed that medications were now stored in locked compartments, and they were very fancy. And so what the pharmacy employees needed to do is that they scanned their IDs to open the doors of the compartments to retrieve medication. So this new system controls requires now that the system controls who has access to the medications, and so it prevents theft in comparison to your typical pharmacy where you walk in and you see that the medications are stored on open shelves. Okay? The second principle is segregation of duties, and this is when different individuals should be responsible for related activities. So to explain this, think of one person who is responsible for using the cash register, and that same person is also responsible for closing the register at the end of the day, for creating the deposit ticket, and for depositing the money in the bank. All those activities that I just mentioned are activities that are related, but if only one person is responsible for all of these activities, this is going to create a huge opportunity for fraud. And that's because no one is going to verify the amount of money in the cash drawer versus what the cash register is recording. No one's going to verify the amount of cash on hand that it matches what the employee recorded on the deposit ticket. So, in other words, the system may capture, let's say, $1,000 in sales, but the employee only produced a deposit ticket for $900, and so the employee pocketed the difference. No one's going to verify that because there's no segregation of duties. So, what this principle is calling for is for different persons to be responsible for different but related activities. So, in other words, one person should be responsible for closing the cash register, another person should verify the cash and compare it to the cash register receipts in order to produce a deposit ticket, and another person should verify the deposit ticket by comparing the cash register receipts and then signing off on the deposit ticket, and then another person should deposit the cash. Now, where I work in my organization, we also have segregation of duties. So, for example, I'm responsible for millions of dollars, and I have to buy supplies or buy equipment or pay payroll for a specific month. So I submit a requisition to purchase something or to pay someone, using my budget. But I do not approve my own requisition, and because it has to go through a process where several individuals verify and approve my purchase request. And then there's another department that cuts a check based on my request and sends it to the vendor. And there's another department that reconciles my transactions. Okay? So that's segregation of duties. We have documentation procedures, which should also be established. And this is similar to what I just mentioned with segregation of duties. There should be a system for tracking documents like receipts, invoices, purchase orders, and different individuals should sign and approve these documents. Okay. We have physical controls, which are ways to safeguard your assets, and that can include safes, locks, computer passwords, logins for different systems, security alarms, TV monitors, red cameras, time clocks for time cards that record the employee shifts, and these could be endless possibilities nowadays. Then we have independent internal verification, and this is when you assign an internal employee, but that is from a different department, to come in and verify your records and also ask them to report when there are discrepancies that have been identified. And then lastly, we have human resource controls, and this is when a business can implement measures to divert employees from committing fraud. And the book gives you 3 examples. It includes bonding employees who handle cash. It includes rotating employees to encourage vacations, and it includes conducting thorough background checks. Now, this last principle, the human resource control, I know that it's not exclusive to people that work in banks, but the examples that are given in the book really refer to employees that work in banks. This is applicable to them. These are employees that are handling cash at all times, so they must be bonded and are required to take vacations, and they must go through thorough background checks. Okay? So now let's get into some accounting principles. And I'm going to be doing this by explaining this visual to you and putting the principles that I just mentioned, putting it into perspective. Here we have a prime example that illustrates the principles of internal control, with the exception of human resource control, which applies more to bank employees, like I mentioned before, due to the requirement of bonding and background checks. So here we have a clerk, right here, who is responsible for entering sales and counting the amount of cash in the register. Okay? So what happens is that this person is responsible for that particular responsibility, but then we have another person who is the cashier, and this person counts the cash that is given to this person by the clerk and verifies the work of the clerk and prepares a deposit slip. And this deposit slip is then given to the accounting department. Okay? That's one component of this whole transaction here. The second part of this process is the register tape. The clerk was in charge of charging the sales and counting the cash at the end of the day, but this process did not include or did not account for the register tape. Okay? So the clerk counts the cash but does not access the register tape. This is accessed by the supervisor, who then sends it to the accounting department for verification. So now the accounting department has both the deposit slip and the register tape. And the responsibility of the accounting department is to verify that the amounts of the deposit slip matches the amount of the register tape. And if it agrees, then the accounting department records the journal entry for sales revenue and for the cash accounts, and the cashier sends the cash and the deposit slip to the bank. Okay, that's in a nutshell what these principles are asking for. Segregation of duties, the establishment of responsibility, the documentation process, the physical controls, and the internal verification, okay? Doesn't really picture here what it was talking about in terms of human resource control. So what happens if the deposit slip and the register tape amounts don't match? Well, the business should have policies and procedures in place to try to determine where the discrepancy occurred. But regardless of that process, if the error is not found and there's money missing, the accountant has a responsibility to report this by entering an entry that reports cash overage or shortage. Okay? So, in this example, it states that the cash register tape indicates sales totaling $6,956.20. And the amount of cash in the register is actually $6,946.10. If you look at these two numbers, there's a shortfall of $10.10. So the way that we account for this is by debiting the cash account. Remember that when you debit an asset account, you actually increase the account. And so we do this because we are depositing the cash in the register in the cash account. But in reality, we should have deposited $6,956.20. Right? Because we have a $10.10 more than what we are actually depositing. Okay? So what do we do to report this shortfall? What we do is we debit $10.10 as cash over and short. Okay? And then what we do is then we credit sales revenue for $6,956.20. We have to do this in order for the entries to match or to balance. We are basically reporting that sales total $6,956.20, but only deposited $6,946.10, and then we are accounting for the shortage of $10.10. Now, when you complete the income statement and you have these transactions of shortfall and overages, you will report it as miscellaneous expense if it's a shortfall. We're missing money, so that is an expense to us. And a miscellaneous revenue if it's an overage. If we have more money than we should have, then that's going to be our revenue. But it's going to be under miscellaneous because we actually really didn't earn that revenue based on a sale, right? It was because of a discrepancy of an error. So, now let's focus on petty cash funds. If there's one thing that you can take away as an advice from this chapter is that a business can have better control of cash disbursements if the business deals with checks as a form of payment, and that is to pay bills or your employees, etc. It can open opportunities for fraud if you, as a business owner, allows the processes to pay for business bills with cash. So you really want to prevent that from happening. You can control that when dealing with checks. So, what about if some of your bills are small in value? Let's say less than $100. It's not going to be practical to cut a check every single time if you have to pay for something multiple times that is less than $100. It doesn't make sense that you have, let's say, 10 bills that are less than $100 and you're going to be cutting out a check for each one of those. Sometimes it makes more sense to have a petty cash fund. And what that means is basically that you have money, cash money on hand, so that when a vendor comes in and is asking you for $50, you're not going to be spending resources to asking somebody else, hey, cut me a check right now, when you could just pay it out of that cash, petty cash fund. So what you can do with these types of transactions is you set up a petty cash fund, which is often called an impressed system, and it involves a three-step process. First, you establish the fund by determining the amount. It could be $100, it could be $50, it could be $25. Whatever that amount may be, it will depend on the business owner. And then you will make payments from that account whenever the opportunity arises for you to make a payment to a bill. And you're going to keep receipts for that, whether it's an invoice or a receipt, but you got to keep documentation. And then once your petty cash fund is almost gone, you could determine an amount. Let's say you set it up for $100. And every time you have $10 or less, you have to replenish the fund. So that's going to be the third step. You replenish the fund so that you always have that preset amount that you determined that you were going to have in your petty cash fund. Okay, so if you just established it to be $100 and now it's $10 left, you're going to replenish $90 to make it $100 again. So in this example, it shows you how to establish the account for $100. You as the accountant will report the entry by debiting petty cash. Remember that petty cash is you're going to have money stored somewhere, right? That is readily available for you. This is an asset. It's money. So remember that in order to increase an asset, you have to debit the account. And then you credit cash by $100 because you are decreasing your cash account. What you're doing is you're taking $100 from your cash account, so you're decreasing it, and you're moving it into, you're moving in those dollars to your petty cash fund. Okay? And that's how you establish the petty cash fund. Plain and simple. Okay? So now you have your petty cash fund established, so you are ready to make payments. So remember that the payment must be documented with a receipt or a voucher, and you need the necessary signatures. And this is an example of what a petty cash receipt may look like. You can adopt that or you may have another form that you currently use. So let's say that you are required to pay 3 bills throughout the day. And those bills total to be $87. You have a postage expense for $44, a freight out expense for $38, and a miscellaneous expense for $5. So you pay them and you keep your receipts, and when you do that, you notice that you need to replenish your account. And you notice that the petty cash fund only has $13 left. So what you need to do is replenish the account so that it has $100 once again. So you do that. What you're going to do is hopefully you're going to have a person that you're going to be asking for more money to replenish your account. Remember the separation of duties, segregation of duties, okay? So this person is going to be asking you to provide them with the receipts to prove that you've actually spent your $87. And that proof is going to trigger him or her to provide you with $87 to replenish your account. Okay? So what you're going to be doing to record that is you're going to debit your postage expense for $44. You're going to debit your freight out for $38. And you're going to debit your miscellaneous expense for $5. Why? Remember that the expense account is part of the owner's equity. And in order to record an entry as an expense, you need to debit it or increase it. Increase the expense account. And then what you do is you credit $87 to your cash account because you want to take out $87 again from the cash account to replenish the petty cash fund. Okay? And that's it for that example. So now, let's go back to the concept of recording shortage or overages. Let's say that we have the same amount of bills as the previous example. We have a postage for $44. We have the freight out for $38 and the miscellaneous for $5. But instead of noticing that you only have $13 left in the petty cash fund, you notice you only have $12. This means that $1 went missing. It's missing. Well, you're going to have to record that so that your books balance. So you're going to have to record the cash overage or the shortage. And you do this by debiting your postage, debiting your freight out, debiting your miscellaneous expense, just like the previous example. But then you also debit your cash over and short by $1, and that is to account for that $1 that's missing. And then we credit for $88, not $87 like the previous example, because we need $88 to bring back the account to $100. Does that make sense? Now, the last concept in this chapter is reconciliation. You have to reconcile your books every so often, perhaps monthly, quarterly. And I would suggest to do it monthly. So we're all familiar with bank accounts. We most likely have a checking account and a savings account. But for your checking account, you receive a statement on a monthly basis, whether it's by mail or electronically. And it records all the transactions that you've made throughout the month. Then you also, as a business owner, should have your own records as to what happened throughout the month. Did you deposit money? Did you write a check? Did you deposit a check that bounced? Did you write a check that didn't have enough funds and it bounced? And so what you need to do on a monthly basis is compare your records with the bank statement records and reconcile them so that you make sure that there are no errors, whether on your behalf or on behalf of the bank. And so this slide is actually going to give you step-by-step process on how to reconcile your records. And it's also going to be useful for the homework assignment that I will be showing you in just a few minutes. What you're going to do is you're going to record the cash balance that is given to you by the bank statement. So you get your bank statement and it's going to show you everything that happened throughout the month. And at the very end, it's going to tell you, based on the month end of June 30th, you have this much in your your checking account. That's going to be your cash balance per your bank statement. Then you're going to add deposits in transit. What this means is deposits that you have made, but that have not been recorded by the bank. So let's say you deposit $100 today, but it hasn't posted on your account. It's nowhere. recorded. That's a deposit in transit. And then you record any bank errors for checks. Okay? Perhaps you made a deposit for a check that was $100, but it was actually recorded as $150. That's a bank error for checks. And then you're going to subtract any outstanding checks that are pending, that you have written, but they have not been taken out of your account. Steps 1 through 4 is actually taking in consideration what the bank has recorded or not recorded that you know of. And then steps 5 through 9, it's going to be based on your records that you have for your business. For 5, you're going to enter the cash balance per the books, meaning based on your records, you know that the cash balance is this amount and you record that. And then you're going to subtract any service charges, any errors for deposits, any TELUS, or any NSF checks. Okay? This may not make sense to you, so what I'm going to do, this is the end of the presentation here. I am going to show you exactly what you're going to be doing for your homework. As soon as I find the page, which is right here. Whoops. You're going to have 3 homework assignments, 3 homework problems. Not 3 homework assignments, 3 problems. And the first one is going to ask you to record a transaction that is going to give information based on what the sales that you've made versus what the cash register tape is recording. And in this case, there's going to be a discrepancy between what the sales are and what the register tape is recording. It could either be a cash overage or a shortage, and you need to account for that. So that's based on the example that I explained to you earlier. The second problem is going to ask you about petty cash funds. It's going to tell you that this petty cash fund needs to be replenished when it contains a certain amount of money, and it's going to tell you that you had to pay certain bills, in this case postage, freight out, and travel expense. And what your job is to conduct a journal entry or enter a journal entry to record the replenishment of the petty cash fund. That's also based on the examples that I went over. The third problem is the one that's going to take you the longest and the one that needs a little more explanation than just the slide that I just talked about. So this problem is going to give you a lot of information that's going to seem like it's overwhelming. So what I'm going to do is I'm going to break it down for you. I'm going to go over it step by step. Remember, you're going to have different numbers yourself, but it's going to be the same similar problem. So let's go over it. It says that Natalie decides that she cannot afford to hire John to do her accounting. One way that she can ensure that her cash account does not have any errors and is accurate and up to date is to prepare a bank reconciliation at the end of each month. Natalie would like you to help her. She asks you to prepare a bank reconciliation for June 2017 using the following information. What this first chart is the general ledger. And if you notice, it's for the cash account. It's just recording what's happening with your cash account, what goes in, what goes out, based on your records as a business owner. So this is for June 17, and it's recording, according to your records, that on June 1st, you have this balance, $2,657. And then what it's telling you is that on June 1st, there was a debit because there was a deposit for $750 into your account. So now your account increased to $3,407. Then on June 3rd, there was a credit for $625 because you wrote a check for that amount, and that check number was 600. Okay? So you wrote check number 600 for the amount of $625. So now the balance of your cash account has decreased again to $2,782. And so that's what's going on in here. It's telling you now that on June 30th you made another check for $95. On June 8th you made another check for $56. On June 9th you deposited more money, so it increased your account. On the 13th you made another check, so it decreased your account. On June 20th you deposited more money. And on June 28th, you made another check, and on that same day, you deposited more money. That's all this little piece of information is telling you. Okay? Now, the second part is actually the bank statement. This is from Premier Bank, and it's the statement of account for your business, and it ends period ending June 30th, 2017. And here is telling you that on May 31st, you had this balance. You had $3,256. Then on June 1st, you deposited money. You wrote some checks. You deposited more money. There was a check that was trying to be, that you wrote, and it didn't have enough funds. So it bounced. Or maybe it didn't bounce, but guess what? The bank actually is charging you a fee because you wrote a check when it was NSF, no sufficient funds. And then you wrote another check. Then you wrote, you made more deposits. There was a TELUS charge, another check, and bank charges. And this is what this statement is telling you. Excuse me. And then they're giving you additional information. It tells you, on May 31st, there were 2 outstanding checks. Check number 595 for $238 and check 599 for $361. Okay? Outstanding checks is that checks have not been recorded as of May 31st. So let's see what this means for number 1. On May 31st, there were 2 outstanding checks, 595 and 599. This, if you look at the bank statement, you are going to see different check numbers here. And you're going to see that eventually on June 28th, check number 599 was no longer outstanding because it was recorded for $361. But do you see 595? I don't see it on the bank statement. So let's see if it's on your records. Is it on your records? It's not either. So this check, number 599, is still outstanding. It has not been, not 599, number 595. 595 is still outstanding. It has not been recorded at all, anywhere. But 599 is no longer outstanding because you see that it was recorded by the bank on June 28th. That's what this number 1 statement is telling you. Now, number 2 tells you Premier Bank made a posting error to the bank statement check number 603, which was issued for $425, not $452. What does this mean? Well, let's look for 603. The bank recorded check number 603 for $452. But there's an error, so let's see where the error is. According to your records, the check that you wrote was for $425. You wrote a check for $425, but the bank recorded that as $452. So that's an error based on the bank. And that's what it's saying in number 2. Number 3. The deposit made on June 20th was for $125 that Natalie received for teaching a class. Natalie made an error in recording this transaction. Okay? So on June 20th, there is a deposit for $125. That's by the bank records. But it says that Natalie made an error in recording this transaction. Let's see what happened. June 20th, she made the recording as $155 on her books, when in reality the check was only for $125. So that's an error that needs to be fixed. Number 4 says the electronic funds transfer, EFT, was for Natalie's cell phone use. Remember that she uses this phone only for business. As of right now, it means nothing to me. Okay? Not for this problem. And then number 5, it says the NSF check was from Ron Black, meaning Ron Black wrote a check that did not have funds. So Natalie received this check for teaching a class to Ron's children. And Natalie contacted Ron and he assured her that she will receive a check in the mail for the outstanding amount of the invoice and the NSF bank charge. Okay? And that is probably this right here, NSF check for $100 that Ron Black wrote and didn't have funds. So now, because it didn't have funds, it bounced. Natalie is being charged $35. So what 5 is saying is that eventually Ron's going to give her another check that's going to be for that $100, and it's also going to provide her with a check that includes $35 charge for the NSF bank charge. So all this information is given to you, and what you need to do is you need to prepare a bank reconciliation for June 30th. You need to reconcile your records with the records of the bank statement. And you do that by following the steps that I provided to you on the previous slide of my presentation. So what I'm going to do is walk you through it so that that slide makes a little bit more sense. And in the slide, I said that the first step is to record the cash balance based on the bank statements records. And that's what it's doing right here. So what you're going to do is you're going to go to your bank statement and you're going to see that at the end of the month, the balance on your cash account based on your bank statement is $3,359. And that's where this amount comes from, $3,359. And then my instruction says that you have to add any deposits that are in transit. Okay? These are your deposits that you have made, but they have not been posted by the bank. So, let's see what deposits you've made. You've made a $750 deposit on June 1st. You go to your bank statement and bam, that's right there. That's accounted for. On June 9th, you made a deposit for $1,050. The bank also recorded that on June 9th for $1,050. On June 20th, you made a deposit for $155. Remember that was an error because it was actually for $125. But in any case, it's still not in transit because it has been posted. That is not outstanding. It's not in transit. It's been posted. You're looking for any deposits that are still in transit. The last deposit, you made it on June 28th for $110. And guess what? That has not been posted. So this deposit for $110 is in transit. And that's what you're going to be taking and recording it on your deposit in transit field for $110. Then it's asking you to record any bank errors. And if you remember on your additional information, the bank made an error to the bank statement with check number 603, which was issued for $425, but it was charged as $452 or recorded as $452. So you're going to record that bank error with check number 603, and you're going to record the difference, the discrepancy, so you can correct that. Not the amount that it should be the amount that it's off by, the difference. In this case, the difference between $425 and $452 is $27. So then we're going to record that as a bank error for check number 603. You're going to add these two statements, these two lines, and these two lines are going to give you a total of $137. And then you are going to add the balance based on the bank statement plus this deposits in transit and bank errors, and that's going to total $3,486. Okay, and like it says here, all the stuff that we just did is these are transactions that increases the cash balance, and you should do it first. Okay, in other words, you look and see what you can do, what you can reconcile based on the bank first. Now, when you do that, you're going to subtract now any outstanding checks. Okay? And remember that outstanding checks are checks that you wrote but that have not been posted by the bank yet. And I helped you determine that earlier because there's telling you on number 1 that there were 2 outstanding checks, number 595 and number 599. And when we looked at your records and the bank's records, we noticed that 599 eventually became accounted for on June 28th, so it's no longer outstanding. But 595 was not recorded, so that check is outstanding. And then we also realized that check number 604 for $297 was also outstanding because it has not been recorded on your bank statement. So if you add $297 plus check number 595, which is $238, those two amounts are going to equal $535. And you record that here. So then you're going to take your balance of $3,486. You're going to minus your outstanding checks for $535. And your new adjusted cash balance per the bank statement should be $2,961. Okay? Now, the remainder of the steps, remember the first steps were based on the bank statement, and then the remaining steps were based on your records. You're going to be recording the cash balance per your books. So you're going to go up here and be like, okay, what was my cash balance at the end of the month according to my records? And that is $3,224. So you're going to record that, $3,224. And then you're going to minus any service charge that the bank is asking you to pay. Service charges, errors, TELUS, or NSF checks. Here we have a service charge for $13, and that is given to us by the bank statement. Bank charges, $13. That's where you're going to record it as a service charge. You're going to record an error in deposit for June 20th. And if you remember, in June 20th, you recorded your deposit as $155, but in reality, the deposit was only for $125. That's where you will account it for. An error in deposit for June 20th for $30. Then you're going to minus any TELUS for $85, and that's given to you right here. Okay? And then you're going to write and record any NSF checks. And NSF checks, remember, it was the amount for the check plus the amount of the fee. And those two amounts is $135. And so you record it as such for $135. And what you're going to do is you're going to take your cash balance per your books minus all of these charges to come up with this amount. Okay? This amount is actually totals all of these charges, and you're going to minus your balance of the books, minus the amounts, and it's going to give you an adjusted cash balance per your books for $2,961. If these two amounts match, the adjusted cash based on your bank balance to the adjusted cash based on your own books, then you're good to go. You just reconciled your bank statement and your records. That's the goal, to make them match, to provide you an accurate balance on your cash account. Because just because you have a certain amount in your cash account doesn't mean that that's in reality what you have, because there's things that are in transit or that have not been posted yet by the bank. So you really can't account for that money anymore. And that's what it's going to take to reconcile that particular problem. Then it's going to ask you to prepare any necessary adjusting entries at June 30th. And basically what you're going to be doing is you're going to be adjusting all of these charges here. These 4 right here. Okay, the service charge, the error, the TELUS, and the NSF. And you know how to adjust entries, and they're going to be based on the expenses, on revenues, or accounts receivable. Okay? And then, last but not least, you're going to say it's asking you, if a balance sheet is prepared for cookie creations at June 30th, what balance will be reported as cash in the current asset section? And basically, this is asking you for your realistic balance on your cash account. So if a balance sheet were prepared, the cash at June 30th, 2017 should be $2,961, which is what you came up with as your matching when you reconcile your records. And that's all, folks. This is all that you have to do for this chapter. So if you have any questions, just get in contact with me and I will try my best to help you. Okay? Good luck to you.